Well, the Bank of Japan, the BOJ, is raising interest rates for the first time in 17 years today, making it the last major central bank to exit the world's negative rate policy. The country is the top holder of U.S. sovereign debt, and as yields are going up, what does this mean for the global bond market? To help break down how investors should be looking at this policy change, we've got Yahoo Finance's very own Akiko Fujita here with us. Hey, Akiko.
Good morning to you, Brad. You're certainly right. This is truly the end of an era when you consider the Bank of Japan, as you said, the major central bank or the last of the major central banks to exit a policy that was largely seen as extreme and risky in the aftermath of the global financial crisis. At its peak, you had the European Central Bank as well as central banks in Denmark, Switzerland, and Sweden all setting their interest rates below zero. And now that Japan's ended the longest experiment, the question is going to become, number one, how effective was this? But also, what does it mean for global markets? We should mention the BOJ governor largely messaged this move, but we did see that dollar-yen cross push lower, with the dollar, or yen, I should say, trading about 150 to the dollar there. It's certainly going to be interesting for U.S. investors to be watching here the impact this is going to have on bond markets outside of Japan, particularly treasuries. This 8-year experiment left more than $4 trillion in funds for higher yield outside of Japan. Japan, as you mentioned, the largest buyer of U.S. debt. We're talking about $1.1 trillion here. And the question is going to be how quickly that money will return to Japan, with yields for Japanese government bonds expected to push higher, though we should point out this yield differential between the Japanese government bonds and other bonds certainly still remains high. Now, the other thing to watch here is going to be what happens to the Nikkei. We've been talking about this a lot. The Nikkei hitting records in recent weeks here, largely driven by fundamental policy changes, but also driven by a cheaper yen, with the yen expected to push higher now. What does that mean for the foreign money continuing to flow into the Nikkei's rise here? Now, as with other central banks, the other thing to watch here is how rapidly the rates are going to rise. We heard from BOJ Governor Kazuo Ueda saying that he doesn't anticipate the accommodative financial conditions will be maintained for the time being, or he anticipates, I should say. So he doesn't expect rates to rise very quickly, because when you think about it, the inflation rate in Japan is still at 2.2%. The Bank of Japan has lagged the major central banks, but we're not talking about the kind of inflation that we saw in the U.S. Now, one more thing to note here. The government did, or the BOJ did, also abandon the yield curve control. That is the bond or the policy here that has kept Japanese governments largely tethered to that 0% rate. And last number to leave you here with, this really speaks to the scope of this policy that has been in place for nearly a decade now, 17 years since the hike. All combined, the Bank of Japan bought more than $6 trillion in Japanese government bonds. And guys, at a time when we're talking about the debt to GDP ratio in the U.S. and Japan, it is the highest in developing countries. 250% of GDP is what we're talking about. So really historic numbers here, but at least the end of an era with those negative interest rates policies coming to an end.
The end of an era, and also the move really creating ripples beyond Japan, noted by a number of strategists, analysts out this morning in reaction to the move here from the BOJ. All right, Akiko, thanks so much.